Great. We're being recorded.
Great. Good afternoon, everybody, and welcome to the second fall hearing of the Joint Committee on Pensions. I'm the House Chair, Brooke Learman. It's great to be here with all of you today. We have a very full agenda, and I'm going to turn it over to my Senate co-chair, Senator Elfreth, to kick things off. Thanks.
Thank you so much, Chair Learman, and welcome everybody. I'm Senator Sarah Elfreth, the privilege of serving as the Senate chair of this joint committee. And I want to welcome everybody to what I think is the hardest working joint committee in all of the legislature, considering especially the work a number of you did over the summertime before we even got to the fall in preparation for January. So we had a robust hearing 2 weeks ago, a number of important issues. And we are covering even more important issues today. So on our agenda, as you can see, we're starting with board requested legislation. Then we're moving on to the state retirement and pension system investing, so report back. And then we're going to have a briefing on the Maryland entrepreneurial ecosystem and then a discussion. We added times to the agenda for the first time, and we will continue to do that moving forward so we can all keep each other in check. All of these are important things for us to discuss, but we also want to be respectful of the committee and our guests' time. So I also do want to especially thank our Treasurer Nancy Kopp for being here. I'd be remiss if I didn't mention the news this week that she's announcing her retirement, and she has been just an absolute, I was going to say treasure, and then I realized that would be odd, but you have, Madam Treasurer, been just such an asset to this joint committee, to our pension system, to this state, and we are so grateful for your 5 decades of service. Thank you.
Thank you.
Hard to imagine the Treasury without you. So thank you for everything.
Thank you. I must point out, I think this committee would appreciate it, that I actually probably have spent about 45 years on or with the Joint Pension Committee. And let me be perfectly candid, a little bit of that was spent trying to get off the Joint Pension Committee, but it didn't work. But thank you very much. I appreciate it, and it's been a great privilege to serve the General Assembly and the State Treasurer's Office, and also a great time to look forward to the future. Generational change is a very good thing. Madam Chairman and members of the committee, I just want to introduce the folks who are here with us. We spoke last week, but Ann Gothrop, our legislative liaison, formerly of the General Assembly, but we wooed her away some time ago. Andy Palmer, you know, the Chief Investment Officer. Dana Johns, you may not know, a senior portfolio manager on Andy's team. And Martin Novin, our executive director. Before I introduce Ann, I will say you raised, a member of the committee, perhaps the Senator, raised the question at the end of the last meeting about live streaming of the board's open meetings. And I had to admit with embarrassment, I didn't realize they weren't being live streamed, but they are now and will be for the future. And I thank you.
Great. Thank you for that.
To our attention.
Yeah.
And
Thank
with
you.
that, Madam Chairman, unless there are questions, I'm representing the board. Unless there are questions for the Board of Trustees, I'll turn this over to you and to Ann.
Wonderful. Thank you, Madam Treasurer. Ann, I think we are ready for the board requested legislation. I know Ann was might have had microphone issues. We cannot hear you, Ann. It worked earlier.
Yeah, it did.
Okay, she's reconnecting.
Okay.
I guess this is where we tap dance.
Yeah. Yeah. Patience.
And do you want to log off and log in? Okay, we will do that.
Okay.
Okay.
We'll just give her a minute. Hi, everybody. Someday we'll be in person again.
I will say to you, Madam Chairman Elfreth, I think that I have always found it really useful to have the times on the agenda, because then everybody can see it. And
right. And these are all going to be robust discussions today, so it's exciting. And my staff and I were just running through legislation before I jumped on, and as I have to keep reminding myself, it is October, and
Yeah.
we have some time. So,
Yep.
Madam Chair,
yes.
while we have a moment, if I could, I think I am probably one of the longest serving members on the Zoom and probably one of the longest serving members on the Joint Committee on Pensions, and just wanted to add my compliments to yours and Chair Lehrman for Treasurer Kopp's just extraordinary service to the state. I had the pleasure of serving with her on the Appropriations Committee, where she was a subcommittee chair when I joined the committee, and just have found her to be a wonderful partner and just a true champion on the Board of Public Works for General Assembly positions, and actually elevated the communication with the General Assembly through her tenure in the office. So, Madam Treasurer, it has been just a wonderful pleasure working with you. And to answer your question, Chair Elfreth, I have been in communications with the Treasurer since our last meeting on the issue that I raised, and am getting wonderful responses from her and Ann and former Secretary Foster and Philip. So we're all advancing those issues.
Wonderful. And folks might remember we had promised to address Senator Griffith's issues, and we are, and it will be a topic for another meeting as soon as we do a little more background.
Yep,
So,
progress being made.
wonderful. Thank
Absolutely.
you.
Since we're just touching on the past, let me say that those years, many of those years with appropriations and with the Joint Pension Committee were with the late Delegate Proctor, succeeded by the present Delegate Proctor, that Jim Proctor chaired that committee for a number of years extraordinarily well, I must say.
That's great.
Thank
And
you.
it's good to have Delegate Susie Proctor on with us today. Great. Was Ann able to rejoin?
I'm not seeing her.
I don't see her. So maybe we should put that at the end.
Yeah.
Okay.
Agreed.
So we will have board requested legislation at the end, I guess, and we'll start then on our state retirement and pension system investing in Maryland. Maybe Chair Elfreth, if it's okay if I just take 30 seconds to frame this. So several years ago, the General Assembly passed legislation that you all know. We have the sweeper provision, which when there's additional money in the general fund, that we can move some of that money into fund the pension system above the actuarial required amount. And legislation that was passed several years ago said, well, that money, we should be focusing on investing some of that, that money into Maryland-based technologies and Maryland-based businesses. And we are here today to talk about whether that is happening, to what extent it is happening, if it's not happening, why it's not happening, and to also discuss, the importance of investing those dollars in high-performing businesses here in the state of Maryland, as many other states around the country do with their pension funds. Being, of course, as we learned last week, being excellent fiduciaries, but also recognizing the power of those dollars to drive important positive economic development in the state of Maryland. So today we're going to hear sort of a couple of different perspectives on that. We're going to hear what's happening from Andy Palmer, our Chief Investment Officer, and Dana Johns, our Senior Portfolio Manager. And then we're going to have a briefing from several individuals who are in this entrepreneurial ecosystem space. Liz Berger from Johns Hopkins Technology Ventures, Richard Griffin, who is the Director of Economic Development for Frederick, and Troy Lamail-Stovall, the CEO of Tedco. So really excited about this discussion. This is an incredibly important topic to all of our communities and to the pension fund. So thanks for joining us, Andy and Dana.
Fantastic. So is my video, my audio working?
Yes.
Okay, great. Fantastic. So good afternoon. It's great to be with you again. As mentioned, my colleague Dana Johns and I will have a short presentation on in-state investing with a focus on venture capital. But before I begin, let me just make sure we got 30 minutes, and that's for the presentations and questions, or questions following the presentation. I think we'll be okay within 30 minutes either way, but just making sure. I think I was the source of making sure we had times on the calendar last time,
Yes, you were.
So I appreciate it. It was confusing because we thought it was going till 5 o'clock, so we thought we had plenty of time. So very appreciative of your time and don't want to abuse it. So we'll move right along. Philip, I think we have a slide presentation. If is Philip going to drive that or share the screen? We did that last time. Perfect. Thank you, Philip. Notes in front of me here. Perfect. Thank you. So on slide 2, we just have an overview of our presentation. I'll spend some time describing the MSRA experience investing in and through Maryland companies. And then Dana Johns will spend some time providing the system's perspective on venture capital, how Maryland fits into the overall venture capital landscape, and how the system can be supportive of the Maryland venture ecosystem. So we'll talk about that throughout this whole presentation. The main takeaways I think you should have from this presentation is that the system has been effective investing in Maryland through our managers, but that venture capital is a small but very productive part of the portfolio, but it is also one of the ones that carries the most risk, and it's some of the most complicated things that we do from an investment perspective. So finally, the system is committed to continue to promote the economic success of Maryland in ways consistent with its fiduciary focus on producing excellent returns. Slide 3, Philip, please. And we saw some of these last time we met in the summer. On page 3, this chart shows how we are investing through Maryland managers, not in Maryland company, but through Maryland managers to demonstrate that we are open to investing in Maryland. This is a list of our managers in the public space, so public stocks and bonds. It shows that as of June 30th, we had these 5 managers who managed a total of nearly $3.5 billion. And this represents about 6 times the share of all similar managers in the defined benefit market in the United States. So on the bottom left, it shows that 8.1% of our public market assets compares to Maryland managers that manage public assets, bonds, and stocks are only about 1.3% of the nationwide defined benefit market. So we have 6 times the amount of money with Maryland fund managers in the public space than they represent in defined benefit plans nationwide. So a lot of, and the star shows that they have provided really strong returns. Those are returns above our benchmarks and net of fees. So some really remarkable returns. We started this durable partners manager just a couple of years ago, and they outperformed by almost 23 percentage points. It's huge. Page 4 is a similar chart for our private managers. This is smaller. It represents $278 million, but it's still a larger portion, as you see in that bottom left-hand corner, than the private managers in Maryland relative to those represented in defined benefit plans. And these managers are also providing strong returns with the exception of Tedco, which is a special case, and we can talk about that a little bit later. And then finally, on page 5, we show that nearly half our assets are now managed by your investment division staff here in the system. And have I thanked you for working with us to help build this team out? I think I have, but I'm going to keep doing it. Thank you again for working with us on this, because this has been impactful on how we approach the market. So overall, with the public managers, the private managers, the in-state managers, in-house managers, we have more than 16% of our assets managed by people located in the state of Maryland. So lots of investing going on in Maryland in public markets. Turning to how Maryland fits in the investment landscape, on page 7, there's 3 pie charts. So this is turning from who manages the money to where the companies are located that we invest in. These are 3 pie charts that show Maryland's share in public and private markets. The one on the left-hand side shows the Russell 3000 composite, which is our U.S. equity benchmark. It's a bit broader than the S&P 500, which many of you know. Maryland companies represent only 0.83% of market value. So less than 1% of companies in the U.S. stock market are in Maryland as a place of residence. On the right-hand side is a similar chart for private equity. This shows the number of dollars that were invested in private equity companies in the United States from 2016 through 2021, June 30, and a similar number, the Maryland companies receiving private equity dollars were about 0.8%, 0.8%, again, less than 1% of all the money going into private equity. And then in the middle is venture capital, and that shows that even smaller percentage, only about 0.5%, 0.5% of dollars that went into venture capital in Maryland went into venture capital in Maryland versus the nationwide. And that's not that surprising, considering that we know that there are some really big hubs in Silicon Valley and Massachusetts and New York that drive a lot of the venture capital activity in the country. And so we've talked about it in the past, and that is an issue for venture in Maryland. To put these numbers in context, Maryland has a little over 6 million residents, and that's about 1.8% of the country's overall population. So the corporate activity in Maryland is lower than representation in Maryland. That might be explained by the very high effect of federal government providing jobs in the area and military. But so Maryland is relatively small in the overall landscape for investments for the system's opportunity set. On page 8, looking at the private markets more closely, this is a chart that shows through all of our managers that we invest with, how many dollars have been invested in Maryland from 2016 through June 30, 2021. Each line represents a different asset class. So private equity, our investments in Tedco, our real estate investments, and our private credit investments, all of which are covered by the legislation since 2016. In the second column there, it shows that those total $172 million have been invested in Maryland companies since 2016. Importantly, we're a small part of these funds. So our $172 million represents our short share. On the right-hand side, you'll see that those funds actually invested $2.9 billion in Maryland through this period of time, supporting economic activity and businesses in the state. One last point I'll make is that the private equity dollars invested of $66 million represents about a 2 times weight of what it would be in the marketplace. So that's about 1.5% of our private equity investments over the period. And the industry, as we saw on that previous slide, was only about 0.8. So our investments in private equity were about twice what it would have been if we had just had a representation in the marketplace. So this page demonstrates that the system is making good progress investing dollars in Maryland companies consistent with the statute, but most of it is not in venture capital, which we know is where the committee sees the most need. Tedco, which is the second line there, represents almost all of our venture capital investments. We did have some in that private equity line. The small dollars didn't justify breaking them out. So our managers have found few venture investments within the state, despite the state having some great opportunities, as I'm sure we'll hear from subsequent presenters. So this is one of the areas where we think that the system can have positive impact, making sure our strong venture managers, which Dana will talk about, know about the great things that are happening in Maryland. So at this point, I'd like to introduce Dana Johns. As mentioned, she's a senior portfolio manager in our private equity team, and she focuses a large part of her time on our venture investments. Well, the whole team works on a venture, but she's got most of her time spent there. She is also the chair for reference of our Diversity, Equity, and Inclusion Committee and has leadership roles in the private equity industry. She's recently was named Member of the Year by PE Win, the Private Equity Women's Investor Network, where she is currently the co-CEO. So very active within the system and within the industry and as a leader. So I'll turn it over to Dana.
Thanks, Andy. Philip, can we advance to slide 10? I'll just stay here for a second and then we'll go to slide 11. Good afternoon, Madam Chair and members of the committee. We appreciate the time you have allowed for us to talk about our investment program and how it intersects with the Maryland innovation ecosystem. Philip, could you move to slide 11, please? Thank you. The private equity portfolio is a performance growth engine for the systems investment program. We're allocating annually about $1.5 billion to maintain our private equity allocation target of 16%. The commitments we make annually to our external fund managers include buyout managers, growth equity managers, and venture capital managers. Today, I'm going to focus on our venture capital portfolio, which is currently about 13% of the 10 billion portfolio target. And we're committing about 150 million to 200 million annually to venture capital funds. As a proportion of the market, that 200 million per year would result in about 1 million per year in Maryland venture companies. You can see on slide 12, the venture funds in our portfolio that we consider high conviction and long-term investment partners. This is a multi-stage venture portfolio. So we have managers that are investing across seed, Series A and B, Series C and D, and late stage. On slide 13, I wanted to just talk about, how our managers, how we're thinking about a startup's funding path and what happens at each of these venture rounds and who's involved in these rounds. At the seed rounds, investors are taking early high risk to invest in a company, and they'll have a percentage of ownership. Generally, it's 5 to 10%. But this introduces a bit of tension as the entrepreneur does not want to give up ownership of her company, but needs capital to start the company. In Baltimore's ecosystem, potential investors in these rounds include Tedco and Techstars, JHU Technology Ventures, and other accelerators, seed, and angel investors. At Series A and B, the entrepreneur is still continuing to achieve proof of concept, gaining traction with product market fit. Simultaneously, though, the existing investors from the seed rounds and the entrepreneur are looking for strategic venture capital. These investors will participate generally in this financing round, but additional capital at this stage will help the company continue to scale and grow. Strategic investors will sit on the board and provide management teams with operating experience, introductions to customers, and making their extensive networks available. This is a stage that Maryland startups find challenging today to find local investors and talent and this is where a lot of the outside VC dollars are coming in. Series C and F are the late stage rounds where the company has grown revenues significantly and may not be profitable because they're still reinvesting, all of their cash back into the company. The funding rounds are much larger and attract crossover capital, like Andy mentioned, where investors with durable, late stage investors and strategic partners preparing the company to go public. Pension dollars can be impactful at this stage with the larger checks that we can write to help the earlier stage GPs maintain their pro rata shares of the companies. Private companies are staying private longer, and this has provided an opportunity for institutional investors like Maryland to participate with lower risk, but potentially greater returns. I'd like to take a step back and set the context for why we have venture capital in our portfolio. As Andy mentioned earlier, it is one of the most risky and complicated asset classes, but also the highest performing asset class. If you are invested in the best and most productive venture capital managers. We've highlighted in several slides the case for venture capital. Top quartile fund managers are driving alpha and outperforming other asset classes over multiple periods and market cycles. Slide 14 shows that on a comparable investment pace, the average venture manager, which are the yellow dots, has outperformed the stock market in most years. And the green bar shows that the best top quartile, 25% of managers is doing exceptionally well. Slide 15 shows that venture has a wider dispersion of returns than other asset classes, and we target being in those top quartile managers. Slide 16 data shows that a top quartile venture fund managers generally continues to raise and invest subsequent top quartile funds, compared to bottom quartile managers, which continue to raise and invest subsequently bottom quartile funds. Much of this has to do with the venture network and relationship driven deal-making environment, as the best venture managers source and attract the best entrepreneurs and startups. It's not only these identification of these unicorns, the $1 billion companies that drive success. Great venture investors work with management, sit on boards. They bring important industry experience. And to be clear here, if agency staff were able to evaluate and make direct investments into startup and early stage companies, we'd probably likely not be able to achieve our investment objectives. And again, startups need investors that have experience creating companies. Great venture investors help turn good companies into world-class companies. As opposed to thinking about investing in individual companies, we think about finding great fund managers that help build a portfolio of companies. Some of them may fail, some of them will be average, and a few will be stupendous. The persistence of these returns is extremely important, as it helps to mitigate asset class risk. Venture offers significant diversification to our portfolio, as it has a low correlation to other asset classes. And the long-term nature of venture aligns with the long-term outlook of the pension. Over the past decade, the public markets have seen fewer new investable public positions. This is because venture-backed companies are staying private longer, and value creation is happening when the companies are private. And one of the downsides of this persistence of top quartile performance is that the best startup companies are concentrated usually in about 30 venture managers. This makes it extremely competitive to access these funds. Recent entrants to the asset class will find it difficult to get an allocation to these managers. Again, the fund sizes are generally smaller than on our buyout and growth equity managers. So this makes it challenging for pensions to access, because we're making very large commitments to maintain our annual pacing of $1.5 billion. And I'll turn now to slide, Philip, if you want to go to slide 18. Little bit of talking about our ecosystem. The state's been very proactive in promoting economic growth and jobs over the past 25 years through various programs dedicated to early. These efforts have been focused on creating jobs and successful businesses. The system's performance return focus requires us to find those companies with the potential to create substantial wealth. And this is really kind of only a subset of the great companies supported through the state's program. I went on a bit of a listening tour over the past year to understand better the investment landscape and opportunity in Maryland, and to share more about what our investment program looks like. I talked with investors, entrepreneurs, network and ecosystem partners, and we talked about the investment challenges we all face, but more importantly, where our successes have been, and what work needs to be done to create a strong, investable startup ecosystem in Maryland, and how we can be partners in this journey. The ecosystem, while vibrant, is currently in the beginning stages of providing capital for early stage companies. The funding scarcity is real at the Series A and B level, and is a real challenge right now. We will continue to cultivate these relationships with the public and private investment community to support the growing entrepreneurial ecosystem. We believe, based on our experiences, that the system's assets are most impactful if they're invested in later stage companies. We stand firm that our existing commitments to Maryland companies through our fund managers are a valuable contribution to the state. Thank you.
Thank you. Andy, you're on mute if you're trying to say something. Andy, you are on mute. It looks like you're talking, but we can't hear you.
Sometimes that's best, but here I am. So thank you, Dana. We're open for questions, but just to summarize, the legislation began with $25 million back in 2016, and we began working to try to invest that and really honor the focus on venture. And that is why we partnered with Tedco early on. Tedco's gone through some changes, and so we're kind of paused there, trying to wait for them to see if they have a new strategy that will work for us. And in the meantime, we've been pivoting and working to find potential other partners, and Dana has been working, as she mentioned, to really understand the environment that we're going to try to invest into. At the same time, we do believe we're investing through our existing partnerships, and that's how we invest. We invest with experts. We talked about this last time. We invest with experts in the fields, and we expect them to make great investments for us. So that has been our skill set, and we're working to understand how that can apply in this setting. So at that, we'll open it up for questions, and thank you again for the time to present.
Thank you. I see Delegate Krim has a question.
Thank you, Madam Chair, and thank you for that presentation. Correct me if I'm wrong. You said that 13% of our current investments are in venture capital. Is that correct? Is that what you said?
13% of our private equity investments.
Oh, okay. Are in venture capital. All right. And who has determined that percentage?
So that is determined through conversations between the private equity team and me, as setting investment philosophy and targets. It's a little bit dependent on the market. The market that's been about a representative piece of the market. It's grown a bit more lately because venture was so successful in the last couple of years that it's actually grown a bit in the market. It's about 17% of the private equity market. It's also driven by our capacity to get access to those really strong managers that Dana mentioned. They tend to have relatively small fund sizes, as Dana mentioned, and we can only be a portion of that. And so we are kind of limited in how many of these things we can get into, and we can only be in the best. So it's kind of a combination of what's the best size for us, what's implementable, and how the assets are performing.
So do you ever, is that like a ceiling for you? Or does that fluctuate according to what's available?
So it's not a ceiling. We were much lower in venture capital when I arrived in 2015. So we've been trying to build this out as part of our growth portfolio, recognizing that the only way we can do it is if we can access these really high quality funds. So that's really the ceiling, is how many of these high quality funds can we access? And you really have to think about the risk as well, because it's been great lately. Right. But if you remember back in 2000, we went through a period of time when I went through a decade where venture was really poorly performing as the whole asset class was. So yeah, it is very risky and it has long periods of underperformance. So we have to manage that.
Yes, I understand risk. And just one more question, Madam Chair, at this time. And do you ever run these decisions by the board as to the percentage of investment you have in venture capital? Would that be something you would discuss with the board and take a vote on?
We talk about venture capital in the context of private equity, and we review the private equity portfolio with our consultant every year. And so we do look at the venture component, but the board has not voted on subcomponents of asset classes in terms of implementation. Our task is to find the best implementation relative to the targets they've given us, which is basically the broad market for those asset classes. So no, the board has not weighed in on the size of any particular asset class.
Okay, thank you. Thank you, Madam Chair.
Of course. Senator McCray.
Thank you, Madam Chair. And thank you, Mr. Mr. Palmer, for the presentation. I saw in the first part of the presentation, you gave a list of the fund managers.
Yes.
I easily recognized Brown Capital as one of the fund managers. I know that they're a minority. I guess that the question would be is, could you elaborate on if there are other minority fund managers, and if so, what percentage of the money do they hold?
Sure. Yeah, that's we have that information is provided every year as part of the Government's Office of Minority Affairs report that we provide. So yes, but to your question directly, even on that one chart where you saw Brown, there are two other MWBE firms, which is Profit, and that's a Maryland firm, and the other one is New Century, which is a woman-owned firm in Bethesda. So just those two alone. We have approximately 15% of the total fund assets with diverse firms, and that's including the assets managed by staff. So if we focus on money we actually put outside, it's about 17% with diverse firms.
Thank you, and thank you, Madam Chair.
Of course.
I just had one question. So I should have perhaps done this at the beginning, but I wanted to go back to the 2016 legislation, and just for the committee's knowledge, it's SB 982 from Senator Casemeyer in 2016 that was passed. And I just want to read a little bit from it so people understand where we're coming from. It says, it is the intent of the General Assembly that state contributions in excess of statutory requirements be invested in the state, with a goal to increase the risk capital available in the state if the investments are consistent with and do not compromise or conflict with the fiduciary duties of the Board of Trustees to the participants of the several systems. And then a little bit further down, if the Board of Trustees does not enter in an agreement with the Maryland with Tedco or another entity in accordance with paragraph 1, the board shall develop a process that authorizes Tedco or another entity to provide recommendations regarding investments in private equity and venture capital in the state with respect to the additional amount described under paragraph 1 of this subsection. So I appreciated Dana, your overview of Series A, Series B, Series C, and that we are concentrating on Series C. It feels like when we passed this legislation, it was the intent, though, that we do increase that risk capital available, and that it would be done with the dollars that are in excess of statutory requirements. And I have heard sort of no discussion of that. And I don't know if I understand you were working with Tedco for a little while. Now you're not, and I'm wondering if there has been development of a process that authorizes Tedco or another entity to provide those recommendations regarding investments, if that is being done.
So the answer to this, is our primary focus was with Tedco. So we did focus on Tedco initially. We worked, actually did a competitive process to find other folks that could do it other than Tedco, and we engaged with Tedco, and we had a nice run there. They are still under contract to us. We still have a relationship with them. That's a little bit suspended while they reorganize. While they've been reorganizing, we have been exploring other potential vendors to provide similar services. They don't have it's hard to find somebody who has the local experience that the Tedco people had at the time. And so we've been evaluating. We've had, I don't know how many meetings we've had with outside parties, different proposals. So we've been working on it and trying to figure out how to do it in a way that meets our fiduciary responsibility. You can see that if we go to Philip, I don't know what page it is. Let's see if I can find it. On page 26, Philip, I don't know if you can pop that up there. So this is what we're really focused on, is that we have really good results with our venture capital investments. And this chart shows all of the investments that we've made from 2016 on with fund managers investing around the world in venture capital, and includes Maryland Innovation Fund, which is our Tedco investment. And we've made a 6% return with that investment. And to be fair, the fact that we kind of stopped in the middle has probably depressed that return. There are investments that we might have made had that gone on, that would have made that better. But this is still the risk that we took when we started off with Tedco. And so,
and what are you doing to keep, so this was about the money that is in addition to the actuarial amount, and I'm wondering what the system's doing to identify those dollars, because that would be hundreds of millions of dollars at this point, not 1 million, which, you know, was estimated to be the proportional share of venture capital that Maryland has in the country.
Right. So we have the money that's with Tedco that we mentioned, which was a $25 million commitment. And we believe the law also it broadens further than just looking at venture. It includes private equity generally, includes real estate, includes credit. It includes companies that are based in Maryland or have significant operations in Maryland. And so we have been focusing on this because we know that's the intention. But as I mentioned earlier, we've actually invested a lot of money in Maryland through our partners over the years, which we believe helps fulfill that commitment. And so each one of those managers are creating investments in Maryland for us for the system.
Right. I guess I don't, unless you have an attorney general opinion saying that satisfies the statute, I would be surprised. I think investing in a firm is different than investing in risk capital. Just to go on in the statute, it says the investments or recommendations made in accordance with this section shall include a goal of investments or recommendations for the investment of 50% of the funds in commercialization of technology sponsored or created by a university in the state. I didn't hear too much about that, but so we can move on. I don't want to belabor this point, but I guess I do have concerns about, I respect the work that you're doing, but I don't believe that at this point it's in line with the statute that was passed. So really excited to continue working with all of you to make sure that we are using those funds that are above the actuarially required investments to stay in line with the statute that was passed 5 years ago. Senator Elfreth, do you want to?
Yeah. Chair Learman, I just want to continue this line of not questioning. We're not attorneys, but just thinking and brainstorming. That's what, it's October. We're here to brainstorm. So Dana, I want to thank you so much for, it sounds like you went on a whirlwind tour over the last year, looking at what we're doing well, what we can do better, other best practices. If you were in our shoes, and we can all agree that we have the policy problem we're facing right here is that, to your point, we have this missing middle of investment in Maryland companies. So what, and I'm particularly interested based on my subcommittee on higher education spinoffs and technology. So what would you do if you were in our shoes?
So, first let's talk about the ecosystem. I think that when I've talked to entrepreneurs, there are a lot of angel investors. There's a lot of seed investors, accelerators, where the missing piece, the link to lack of access to capital is the Series A and Series B. So I think it's not even clearly if Tedco, in their reorg, is able to invest, additional dollars in growing the number of companies that they're supporting at the Series A and B, that would be awesome. But also, it's generally the ecosystem. I think that in other large tech hubs, what you have is you have a lot of investors, venture capital investors, and you have a lot of talent. And I think we have a lot of talent. I think sometimes our talent leaves, or, we also have, we have a lot of government, kind of very close to us, where I think a lot of the talent, tech talent might, move into government agencies. They might spin their technologies out and commercialize them, so there's kind of, it's a unique ecosystem that just, we need, several very successful companies, which we already have, but we need more of them to spin off talent that then, entrepreneurs that want to create their own companies. So it's a, kind of, I think there are a lot of people working on this problem. I was involved over the summer. I spent a lot of time with the government and policy team of Upsurge, kind of looking at what are quick fixes, what are moonshots, things like that. And I think, it comes down to access to capital. And I think it's, access to capital, smart capital, and I think it's productive capital.
Very well said.
Thank you. All right. Seeing no other questions, Delegate, do we want to move on to the entrepreneurial ecosystem, or should we bring Anne back in if Anne's microphone is working?
I would say let's go to ecosystem and do Anne after, so we can stay on the same headspace. If that's okay.
Okay. Then I'll introduce our first guest, and thank you for your patience. We have Liz Berger, who serves as a Senior Director of Strategic Initiatives at Johns Hopkins Technology Ventures. In this role, she ensures that the venture fund's resources are deployed effectively to enhance commercialization and innovation activities across the university and the region. Prior to joining Hopkins, she was the Executive Director of Evergreen Healthcare, a post-Affordable Care Act health service startup organization. She's worked in business consulting, and she holds a bachelor's degree in public policy studies from Duke University and an MPA from New York University's Wagner School of Public Service. Liz, thank you so much for joining us.
Thank you for the introduction. I'm going to go ahead and share my screen. Can you all see this?
Yep.
Is this on full screen?
Now it is, yes.
Great. So thanks for having me. I'm here today to talk about the Johns Hopkins University startup ecosystem, which is a rich core of the larger ecosystem in the state that is blossoming around us. I'm glad to hear that so many folks have studied this. We are very proud of the progress that we've made. So I'll talk a little bit about that current landscape, as well as some reasons to feel optimistic about the pipeline for future investment. I want to start with a bit of a vision. Speaking of landscape, Johns Hopkins Technology Ventures sees between 400 and 500 discoveries a year. Many of these have the potential to become products and companies that save lives, but also that create economic activity in Maryland. So company building, creation of jobs, cultivation of talent, some of the themes that Dana touched on, and the manufacturing of life-saving technologies is very much Maryland's future. You can imagine a state that's known for the clusters, the areas of innovation listed above. And so the task at hand, as we see it at Johns Hopkins Technology Ventures, is to take this brilliant science emanating from our academic institutions and to turn it into economic activity, but specifically economic activity that happens here in Maryland versus elsewhere. So I'll speak quickly about the life sciences. This vision is certainly not far from reality in this industry. We gain lots of attention for various sectors, but life sciences is, as you can imagine, an area of concentration for Johns Hopkins. This is but one study. There are various measures. You've got rankings. We are number 4 as a top biopharma cluster in the nation. Baltimore is recently ranked by Forbes as number 5 on the list of startup cities. So the list goes on and on of acknowledgement that our ecosystem is indeed maturing and robust. So what are the drivers of this regional excellence? Well, the density of anchor institutions is certainly a big driver. So from Hopkins' perspective, for 41 years in a row, we have been named the leading spender of federal research funding in the nation. This means that we are about as high concentration when it comes to discovery as you get. And so the challenge for Johns Hopkins Technology Ventures is to figure out how do we take that research density and turn it into products on the market and, again, economic activity. So for those not familiar with a commercialization team at a university, our job is to take to take discoveries that result from research, to file intellectual property, sign licensing agreements to companies, some of which are existing companies, others are startups, and then wait and hope that those things turn into real products and services that are used in the marketplace. So when we do license a technology out of Johns Hopkins to a startup company, we get what we call a portfolio. To be clear, this is not an active investment portfolio in that we are not actively choosing to put capital into these companies. Rather, we have a financial stake in them because they are licensed technologies. We currently have 174 startups in the Johns Hopkins portfolio, of which 121 are located in Maryland. If you combine this with the activity at the University of Maryland, which is not represented here today, but they have a similar success story to share. Morgan State, you've got our I-270 technology corridor, the National Institutes of Health. Point here is that Johns Hopkins is not alone. There is very much an ecosystem that is building upon itself. And as Dana mentioned, there's a kind of virtuous cycle of talent and investment and more companies and capital and more talent, et cetera. So I'm very much looking to accelerate that cycle of business building in our ecosystem. So anyone can start a company, but is it investable, and how much value is there in this portfolio? You can see here that there's very much an upward trend of equity being invested in the Johns Hopkins portfolio. We have seen approximately 400 million in venture capital flowing into these companies annually in the last 5 years, compared to, as you'll see, a much smaller rate of investment previously. Importantly, it used to be that only 15% of that capital invested into our portfolio stayed in Maryland, and in more recent years, the majority of that money is staying local. This means that there is some stickiness to the region, and hence the ecosystem building that was referenced earlier. So 1.6 billion has been invested in Maryland companies specifically since FY12. Another signal of the value in the portfolio is the fact that the best healthcare VCs in the world are investing in our companies. So a kind of signal of legitimacy of these investments. Now we bring these folks to campus and try to stay in front of them, but most of them, as you can imagine, are not local to Maryland. In fact, only this handful of investors in the portfolio are actually local capital. And so I think a big opportunity here is for us to think about how do we make the investments themselves local, not just the targets of those investments. These are just a few notable raises and equity offerings from the last year. You'll see several $100 million raises. To Dana's point about the different series in venture capital, many of these are not Series A, but it's not unheard of for us to have 100 million Series A investments. But indeed, there is kind of the average Series A that would be in the 10 to 30 range. Again, most of that is coming from outside the state. Just for a look, these are the four out of the 6 shown here that are local companies. Another way that we measure the value in the portfolio is through exits. These are a handful of the exits from the past decade, exit being an initial public offering or merger and acquisition activity. I want to pause for a moment on Thrive. This is a great story. Thrive was acquired for $2.1 billion earlier this year. They are developing, to give you a sense of the kind of many levels on which these companies have impact, not just economic activity wise. Thrive is developing it's a liquid biopsy test for 8 different types of cancer. So you can imagine you go into your primary care office for your annual checkup, you get blood work and potentially detect cancer that might not have otherwise been detected for years and perhaps at a later stage, pancreatic cancer being a great example of a cancer that's so often detected at the point where survival rates are very low. So we're very proud that while Thrive is headquartered in Massachusetts, they have a large research and development operation locally. And I think that's a testament to the ecosystem that we're building and Hopkins investment specifically in supporting those companies. You don't have to take it from me. The good news is that increasingly the nation is taking notice. It's no longer rare to see Maryland companies making headlines for raising capital. I'll give you one more example of a notable company that's chosen to do business here. Galen Robotics is making surgical robotic arms that help increase the precision and safety of very specific procedures where the surgical skill is otherwise limiting. And the experienced CEO of this company left Silicon Valley to be here in Maryland because of the talent and the belief that he could indeed raise money and grow a company here. you'll see that we we track our data very carefully. We focus so far on dollars. We also track job numbers. Currently, the portfolio accounts for 1,400 jobs in Maryland, 1,200 of which are in Baltimore City. There are many more. These are those which we can verify through surveying our portfolio. And the good news is that even in the pandemic, we were able to grow these numbers. There was notable hiring activity at several companies, despite the many businesses and sectors where jobs were being lost. So I hope I've made the case that there's a lot of great activity coming out of Johns Hopkins and that these companies are investable. I guess the real question at hand for this committee, though, is how the pension fund can seize on this opportunity. So I do want to touch quickly on the role that Tedco has played as an instrumental driver in this ecosystem, particularly when it comes to university startups and technologies. The Maryland Innovation Initiative has provided $21 million in funding to our companies, 81 companies specifically since 2013. This is only Johns Hopkins, significant investments also in University of Maryland and other academic institutions companies. These companies have gone on, by our accounting, to raise 575 million. So that's a multiplier that looks pretty good to me of 27. This is not an investment return, just making the point that small seed amounts of money at the early stage in a company really do help those companies attract follow-on funding. These are 3 examples of companies that we're proud to say are continuing to go on to raise money and create jobs. I mentioned Galen Robotics before. Galen has received $150,000 of very early stage seed funding from the Maryland Innovation Initiative and follow-on funding of 12 million, and now has 25 jobs here in Baltimore.
Liz, I'm sorry, we're going to have to move on to the next speaker because we just have short time.
Okay.
So, do you want to make a closing couple of sentences?
Yeah, I just have one more slide. Just kind of starting where we started. I'm very pleased with the data that Mr. Palmer shared about Maryland investment. I think, again, just to summarize, there's a lot of opportunity here in Maryland. I think Tedco could be a great partner if appropriately structured. And I hope everyone feels optimistic as we do about Maryland as a place of continued economic rewards and financial rewards for the pension fund.
Thank you. I'm going to bring up now Troy, our CEO of Tedco. He is, Tedco, as you all know, is the Maryland, our economic engine for technology companies. Troy leads the organization's mission to support economic development through the cultivation of an inclusive entrepreneurial innovation ecosystem. Prior to joining Tedco, he was the COO at the University of the District of Columbia, which encompasses a 6-site community college, a 4-year baccalaureate campus, and a law school. And he founded the management consulting firm LaVale Stovall LLC and GTMS Partners LLC, and served as the first president and CEO of Gulf South Capital. He has had a long career. He's also been at McKinsey, Southwestern, or AT&T, and Rockwell International. And he is certainly a subject matter expert in capital stack formation, which is a lot of what we are talking about here, making sure that we can keep companies in Maryland because we have the capital that will be available to them so they don't leave for a Boston or San Francisco or Pittsburgh or someplace else. So that's a lot of what we are talking about today, and Tedco is helping us make that happen. So Troy, delighted to have you on today. Thanks for joining us.
Thank you, Delegate. I appreciate you, both co-chairwomen for leading this, and to all the senators and the delegates here today, and my colleagues at Johns Hopkins and at Pension. I appreciate all the words. If I may, I'm not gonna, if it's okay, you have our slide deck. You guys can read that. I want to, if it's okay, I want to just have a conversation. I want to have a conversation on 3 things. I want to have a conversation on what Tedco is, and frankly, what it isn't. I want to have a conversation about this relationship that we do have with Pension. And then I want to invite my Chief Investment Officer, Jack Miner, to show you our performance given what we are. And so let me start with what we are. What we are, as I was thinking about what I wanted to say, Delegate Lehrman, I got to thinking about vegetables and fruit. You know, both of them are good for you. You need both of them, but you can't compare And the point is, Tedco is not a venture capital firm. We use venture capital instruments to do what we do, but you set us up 23 years ago to provide very early stage risk capital to these companies who, but for particularly in some of our communities like rural communities and our women-owned businesses and our minority-owned business, would not have access to capital. So all due respect to our friends earlier, the riskiest capital and the hardest capital to raise is at early stage. And if I may just deviate just for a second, I've spent in my year, a little over a year now, I've spoken to well over 100 of our entrepreneurs here in the state. And I will tell you, the hardest capital for them, particularly for those in our rural areas and people of color and women, is what I call actually pre-seed. It's that stage of capital that's in a $35 to $45, $50,000 range when they're trying to turn that napkin idea into what's called a minimum viable product or proof of concept, so they can then bring that to a Tedco or to somebody, to an angel, to say, this is what this thing can do. This is what this thing can become, or what it could look like. And we actually don't have that capital. And it's a space that I am trying to get us into, because we don't have that actual capital. So I recognize that hole in the Maryland ecosystem that needs to be filled, and we're doing that. But I want to go back to, again, what we are. You set us up to drive economic impact and economic empowerment of ideas and concepts into communities that don't have access to capital. And by the way, you'll see here in a minute from my colleague, Jack Miner, we actually do a pretty good job with that. And so you can't compare us to other ventures because we have constrictions. We have a geographic constriction, which is, south of the Mason-Dixon and north of the Potomac River and west of the Atlantic Ocean. That's our constriction. We have other constrictions that, frankly, some companies don't want because we have certain limitations by statute of the structure that we have to put our money in. And by the way, I'm not complaining. This is the job that I have. We actually cannot serve on boards. I have been both a limited partner and a general partner at venture capital firms. So I've been an investor in this, and I have the ability to serve on boards. I have the ability to hire and fire the team. As Tedco, we do not have that. We are investing in them, and they are what they are. And so we don't serve on the board. We don't have that ability to hire fire like any other venture capital firm would do. And so I think it's important for this committee to understand you have this great instrument. So don't misread what I'm saying. You have an outstanding instrument here in Tedco, but you cannot compare what we do to a traditional venture capital firm, because I've served in a traditional venture capital firm and I know the difference. So that's point one. The second thing is on this structure or this relationship with pension. It was set up with the previous regime, previous managers at Tedco who are no longer with Tedco. And if I'm going to be honest, I get the reason why to do it. And by the way, I get the whole point of pension. Pension's trying to drive, at the end of the day, certain returns. And that's fine. And that probably does run a little counter to what we do at Tedco. And I accept that. But the deal is right now, if you don't know, yes, we have $25 million that's available to us. We've only drawn 14. Once I became the CEO, I've had some conversations with our colleagues at pension. And because of the lack of fees, we don't get paid any fees. We have to guarantee returns and other elements of the structure of the deal. I just felt like it was not a deal that was worthy for Tedco. And so, yes, we have paused. We will not make any further investments with that current deal structure. We will do some follow-ons in the portfolio that we have. And again, Mr. Miner will show you some returns that we've been able to generate and done pretty good on some of them. But the current deal structure is not one that we can operate on or provide any incentive for us to go and do what I think the intent of the legislature, as you pointed out, Delegate Lemon, was to do. And so as a deal as it's structured now, I will be just, you can call me out on it, but we cannot operate with no fees and having to guarantee returns. That's a non-starter for us. So let me now transition to my colleague Jack Miner, and let him give you. And I think he's going to pull up. I think I'm going to pull up the screen here in a minute because he's got some slides he does want to share with you, so you can kind of see some of the returns that we do have in terms of given what we are, given what we're not. I actually would tell you we're actually a very good performer for the state of Maryland. So Jack, you want to take it?
Yeah, thanks, Troy. And thank you for your time, everyone. I'm really going to just talk to two slides in the deck. One is slide 50, which I'll start with. So if you have that slide deck, you can play along from home with that. So I think that the most important thing relative to what we are in the investment side of Tedco is we're a strategic direct investor on behalf of the state of Maryland. We put money to work where it's needed. What we're looking at is really three different asset classes. We're looking at social impact is one, we're looking at seed, and we're looking at venture. And the social impact areas, many of you may have heard of the Builder Fund, have had significant successes with the Pre-Seed Builder Fund and the focus on ensuring that underserved founders get funding to move their companies forward. And so that is one area that the state has said, let's put some money to work there. The second area is in the seed area, where we have four different seed focuses. One is on life sciences, the other is in cyber, the third is technology commercialization, and the fourth is GAP. Each one of those get about $1 million a year that we invest, again, on behalf of the state. And then the third, which is what we've been talking about today, is the venture asset class. And in that, we have been looking at deploying more and more capital relative to the directives that we have from the state. So the strategic direct initiative that we have is that we are here to ensure that we advance the ecosystem around entrepreneurship. And so the complexity comes for us in the venture investing is that because we're state employees, we are not allowed to take a board seat. And a lot of the things that Dana talked about are like, those are awesome things for us. Those would be really great if we had the ability to sit on a board and to really put our thumb on the scale on where these companies are going, because we have the expertise to direct them in a better way and open our network. We're completely restricted from that capability, other than providing them some tangential support in our networks, which I think we do a good job of. Not being on the board, though, we don't have that insight. So because of the fact that we are restricted in some levels, what you'll see and what you see in this slide that Troy is sharing is that our internal rate of return is affected by that. And we are also very early investors. And so because of the fact that we're very early investors and that timing is a component of IRR, again, we're going to get a lower IRR. To Troy's point, we're not your traditional venture fund. And so I've put the data up here to show, yeah, we get it. You know, the 2017 vintage return was 28% IRR. That's not us. The top quartile range, again, from PitchBook and from Cambridge Associates, you can bring in all the data, and we're bumping along the bottom of the median. And then you can find data that would support the fact that we might actually have a near average return over a 15-year time horizon. All of this is said to show we understand that we're not at the top decile. We operate like a top decile fund. We have the transparency and processes that you would expect from a top decile fund, but because of the restrictions that we have, we're never going to get to that level. We will get to the level, although it is, again, somewhat limited on our returns to our investors in multiple on invested capital. And so the points that I have are, we're a strategic direct investor on behalf of the state. I think we do a very good job relative to our peer group in pure venture capital, but with the restrictions and understanding what we have that are going to hold us back a bit with this. And so, Troy, I don't know if you want to pick up on that and continue the conversation.
Yeah,
I think go ahead.
Yeah, no, I do, because I know we're a little bit on time. I just want to add one point to Jack was talking about our seed funds. I think it's important for the legislators. If you recall, last year, you all passed the fifth seed fund called the Inclusion Fund. that inclusion fund, you passed it, but it was not funded. And so we are talking to the governor's office, so we're talking to DBM. It is our top request to get that funded. We're asking for about 1.5 million. Just to remind everyone, the inclusion fund was to do two things. One was to act as a graduating fund, because we found some of our builder fund companies weren't quite ready for seed, and they clearly weren't ready for our Series A investment. And so we created the inclusion fund for that. But the other challenge we're running into is that to be a builder fund by statute, you had to be at least 51% owned by, again, someone from a socioeconomically disadvantaged group. There were times we were not able to invest in companies. And so working with you all, we were able to create the inclusion fund that allows us to invest in companies that are less than 51% owned, but at least 30% owned, and it's an and function, have someone from, again, a social disadvantaged group in their management team. So I wanted to bring that point up. But to close the point, I know we're short on time, Chairwoman, is I'm claiming to be a fruit. Maybe I'm a vegetable, I don't know. But my point is, I've been on the side of our colleagues at pension. They got to get returns, because at the end of the day, we're all part of the pension fund. There's no debating that, and I get that, and I'm not debating that. If you're going to have us as part of that, there has to be a different metric for us. And I want to be a part of it. I think we can be a part of what you're trying to do, the spirit of it, but there has to be a different comparator base in order to do that.
Okay. Thank you, the Tedco team. Fruit or vegetable, we appreciate you. For the folks watching at home, just one quick point of clarification. As we know in this room, the legislature, when we pass a bill, we cannot put money into the next budget. The governor has to do that for the following budget. So it's not that we didn't care about this new fund. We deeply care about it. It's just how our budget process works, and we look forward to
Absolutely.
the governor putting funding in that so we can continue to build out our ecosystem. Thank you.
Yes, ma'am. Thank you for that clarity. Yes, ma'am.
Okay. Senator Griffith.
Thank you, Madam Chairs. Troy, it's always good to see you. Was a pleasure working with you. I know Senator Elfreth Eckert and I got to work with you all a little bit on the President's Work Group on Equity and Inclusion that helped present the bill that you just mentioned, the fund. But I guess I had a question, and you and your teammate kind of drilled home we're early investors, we're high risk. We're not venture capitalists. We're not chasing returns. I get that. I guess what gave me a little pause was the pause that the system mentioned and that you mentioned, understanding the legislative intent as Chair Lehrman described it. Is Tedco the right vehicle to help implement that intent? And if so, kind of how do we get unstuck?
Yeah, no, thank you for that question. I appreciate that. I won't pretend I know the intent, so I will make my definition and you can correct me. I think the intent was, and I think Delegate Lehrman kind of alluded to this, was to drive, to use this tool called the pension fund, this excess capital, to invest in those early stage companies. And I think the wording is actually in the legislature to talk about why I use the word translational research. In other words, work that comes out of like Johns Hopkins, comes out of Johns Hopkins and the Morgan State. And how do you translate that into a business? And that's a lot of what our Maryland Innovation Initiative does, or MII, I think, as you're aware. And we do some of that also through our pre-seed and seed funds. So to answer your question, yes, I think we're the right instrument. I think there is a clarity as to what we do, and giving that clarity. And I think it's easy to call it venture capital because we do use venture-like instruments to do what we do, Mr. Griffin. But we can't be compared because we don't have the same latitude, as I've tried to explain, that a traditional venture capital firm does. So to answer your question, yes, I do think we are. I just think we have a different comparator and a different expectation of what we should be expected to do.
Okay, because I think I've just seen on the faces of colleagues just a little bit of concern about the hard stop or pause in progressing along the path. So look forward to working with you on that. Thank you, Madam Chair.
Thank you, Senator Griffith. And we have one more person on this in this section, but Troy, I want to keep pulling this thread because we legislate with the best of intentions here, and then it goes to implementation and maybe, square peg, round hole. And that sounds maybe like the situation we have. So what do you need from us, because I consider us all partners here, the pension system, the legislature, Tedco, trying to achieve this common solution of better investing in Maryland-based companies. So if you don't have the tools, what tools do you need to accomplish this goal?
Well, no, I'm sorry if I'm not being clear. So I think within Tedco, other than, I'd like to have more scale. Absolutely. So to answer your question, yes, would I like to have more scale in what we do? So if that's the answer, yes. But to answer your question, maybe at a more tactical level, I think there's two issues or two challenges. One is the current structure of the relationship with pension, as I mentioned. I mean, it's not workable for us. It's just not. I think then second is Delegate Learman, and you pointed out, how do you get the intent of what the intent was? How do we bring clarity to that so that Tedco can be that instrument that does what the intent is to do? I hope that answers your question, Senator.
It does. And I just, the relationship that you've mentioned, I think we've touched on it. Is it the ability to regain some fees for the work that you're doing in these investments?
Well, that's one. I think more. Okay. Yeah, that's one. Obviously, that's one. Okay. But two, again, I have never been involved with a venture deal where I guarantee returns or I guarantee a return of principal. I've not been. I've done this business for a long time. I've never seen that structure before.
Okay. And then I think the only other issue I wanted to cover, I appreciate that in the traditional venture capital world, and a firm would have a seat at the table of a company. I think we can all agree that that's just inappropriate for a state investment for various ethics reasons. So I understand that ties your hands in terms of mentorship and guidance for these companies, and maybe we can find an alternative solution to that. But I hear you. Having a board seat's not appropriate, but we can maybe work on finding a solution that makes sense there.
No, I think, look, we've been around for 23 years, and just to be in the spirit of full disclosure, we are going to be coming to the AELR actually the next week. Some of you, I think, maybe on the AELR with some changes to our red that we think kind of, if you will, modernize us in a post-COVID world. And I thought that, to your point of being partners, there's conversations we need to have about not just the rate, but even maybe some statute things. Again, I'm not complaining, but I think there's some modernization that we need to look at to check. And I get some of the constraints was because of what happened in the past. Mm-hmm. Again, I can't run from that, and I get the boundary conditions you all put on us. But I think you also have to understand that those boundary conditions come with consequences.
Absolutely. And as the chair of ALR, the Senate chair, I look forward to seeing those regulations. Okay. Yep, there you go. I've dominated this conversation. I apologize. Chair's prerogative, but I don't see any other hands. You can see we're passionate about solving this problem. Okay, so our final guest and Mr. Griffin, thank you for joining and being patient and for helping us over the summertime as well. But Mr. Richard Griffin is the Director of Economic Development for the City of Frederick. He's had that position since 2002. He's an accomplished urban planner and economic developer with 22 years of planning and economic development experience, working at the city, county, and regional level. He has a tremendous CV, long list of partnerships and positions held, but he also holds degrees from Western Carolina University and Clemson University. He serves on the board of directors for the Downtown Frederick Partnership, Fort Detrick Alliance, Frederick Innovation Tech Center, and Frederick County Workforce Development Board. So this is going to be a very localized perspective, and we greatly appreciate it. Mr. Griffin.
Thank you very much, and it's great to be with you all, Senator Elfreth and Delegate Learman. Also, I'd like to thank my own delegate from back home here, Delegate Carol Krim, who's on your committee with you. Certainly, I have learned a tremendous amount by listening to Troy, Liz, Dana, and Andy today. Things that I think are helpful here, even in my own community. So thanks for allowing me the opportunity to listen and now provide a little bit of feedback from the local perspective. So I'm going to try to see if I can make this work here. You can see my screen, I'm guessing. So the city of Frederick, you know, we've been blending history and technology up here in Frederick now for 275 years. We've transitioned, of course, from the old canning, tanning, and knitting industries of yesteryear to, you know, biotech, Bitcoin, beer brewing, and a whole bunch of other things. So, you know, we've seen the change, and we see the transition into these entrepreneurial companies. It's paying off for us. In addition to many other things that Frederick is doing, just last week, we were recognized as the #4 top places to live in America by livability.com. So we're really proud of that. And of course, the work of the state legislature has been huge in helping us achieve much of that work. Just to put it in perspective, the city of Frederick, we're about 75,000 residents. And I think the reason you asked me to this committee is, you have several other cities, Rockville, Gaithersburg, Bowie, that are all in that same size range here in the state of Maryland. Our city, we have a little less than half of the businesses in Frederick County and a little less than half of the employment of the county here in the city of Frederick, but we only occupy just a fraction of the land area of the county. We are, though, one of the things that's been super helpful to us, being a neighbor of Montgomery County and being on the 270 corridor, which of course is that tech byway that comes up and anchors up here in Frederick with many of the federal agencies along 270 and in Frederick. And just, so that you understand, we only have about 40,000 people in our labor force that are actually from the city of Frederick. But that labor force, we have a pretty high labor participation rate, high school diplomas, bachelor's degrees. We have a lot of people that can start businesses, and we have a pretty robust entrepreneurial climate in Frederick by these folks that are working for someone else but have a vision for starting something on their own, whether it's with technology or otherwise. And of course, biotech, life science, manufacturing, healthcare and education, and technology kind of round out our primary industry groups here. One of the growing industries, of course, has been the craft beverage industry, and we now are employing quite a lot of people in this industry here in Frederick. But what I want to go into is kind of the size of business, and then how Frederick is approaching entrepreneurial activity and how the pension fund could perhaps play a role in that. In Frederick County, there are about a little over 10,000 businesses, of which I have data on about 9,700 of them. Many of them, as we showed before, about 43% of them are in the city of Frederick. But the vast majority, over 7,600 of them, 77% have less than 10 employees. 96% have less than 50 employees. And we're just going through this, what is a small company? SBA defines it as 500 or 250, depending on what kind of investment they're making in the company. The U.S. Chamber of Commerce usually talks about businesses under 100. Here at the city, we've kind of used 50 as our rule of thumb for a small business. But you can see that the vast majority of our businesses are very small. Many of them are mom and pop shops. And while our goal in the past has been, business retention, expansion, and attraction, in 2003, the city of Frederick got fully into helping drive entrepreneurism here in our community and growing jobs here. And the way we did that, because we didn't have the skill set inside of government to do it, we created our own high-tech incubator as part of the Maryland system. So we approached business incubation and acceleration of tech firms by creating this thing called the Frederick Innovative Technology Center Incorporated as part of the Maryland incubator system and network. And that entity created by the city and the county has been the entity that we've invested in to try to help drive the type of companies that we heard about Liz and Troy and others talking about in terms of the kind of companies that we want to see investment go into. So we have two facilities. One of those facilities, the Monocacy facility, is pretty dated at this point, and we're working on recapitalizing that lab space. But over the time that FITCI's been in existence, we've created 125 companies, created about 800 jobs in the community, over $26 million in annual revenue by the companies that are in existence. And they've leased over 68,000 square feet in our community now from graduate companies. I just want to point out that the original facilities were largely paid for by the city, the county, and a major investment from Tedco and what is now the Maryland Department of Commerce, about $1 million total. And, I'll talk more about how the pension fund perhaps can play a role in this, but understanding that a one-time investment in this system isn't sufficient to keep the system running indefinitely. FTSE provides a lot of different programs, but one of the programs that it provides is access to capital. It tries to help the companies that are at our high-tech incubator gain access to the resources that they need to scale, to grow revenue, and to be able to be successful. And that comes from a wide variety of sources. For our smallest companies, and these can be very small, and they have income producing startups from the very beginning.
Richard,
yes,
but two more minutes if you can.
2 minutes.
Land
I'll just say that we use obviously the same traditional financing systems that all of the other communities in Maryland are using, but I do want to point out that the Tedco has been huge for our tech companies. All of the different research funds, venture funds, the Hopkins Innovation Initiative, all of these, we have companies that are participating in all of these different programs. I also want to mention DHCD because they've been very aggressive with their Neighborhood Business Works program that's helped a lot of companies. And I want to end by saying that focusing on capital assistance to the incubator and accelerator system could potentially be a good resource, a good use of venture funds or pension funds. And then finally, providing direct capital and operating assistance to those startup companies like we heard Troy mentioning, that's huge. And finally, just capital for minority, disadvantaged, and women-owned businesses is something that we have been focusing heavily on. And I would encourage us to continue to make sure that we're making sure that proportionally we're getting that resources into the hands of those types of companies. I really appreciate it. Thank you very much.
Thank you so much. That was a wonderful perspective, and to go deep on the ecosystem at the local level. We appreciate that.
Yeah, that was great.
All right, I do not see any questions, but we can. This was I dominated earlier, but we can now have questions if anybody has questions for Ms. Berger, Mr. Griffin, or Tedco.
Okay.
Not seeing any. Okay.
Do you want to call up our final?
Sure.
Okay.
Anne's
Okay.
microphone is working. Thank you, Anne.
You can hear me. All right. And this is shifting gears so dramatically from what you all have just been listening to. So I'm going to be presenting today. We have 4 very technical proposals having to do with our benefits program. I'm going to be back next month with a few more proposals that are going to focus really on our investment program. So for today, let's get started with the first proposal that has to do with our trustee elections. Right now, our board holds 5 members on the board, 5 trustees who represent the retirees and the members of the system. The law requires that one of those trustees be a member of one of the systems, not including the teachers' plans or the state police plan. It requires that another individual, another trustee, be a member of the teachers' plan, and that a third be either a member or a retiree of the state police plan. And for purposes of defining member, the law states that a member is either an active member or a former non-vested member, but still within their 4-year membership window after they leave service with a participating employer. The provisions of law that address board membership, when referring to the trustees who must be members on the board, it only references members. It doesn't specifically state whether those trustees have to be active members or non-former vested members. Additionally, the law provides that the people who elect their representatives to the board, that they are the members and the retirees of the appropriate plan. But it doesn't specifically again state whether the members who are voting are active or non-former vested or either it could be both. It's just silent with regard to that. Looking back over the last 10 years, we could find no instance, and I'm sure this goes back to the history of the board, but I can only go back 10 years. We could find no instance where a non-former vested member was elected to serve on the board to represent their plan. And with regard to board elections, the existing practice of the plan of the system has always been to just send ballots to the active members of the system. We're not aware of any other plans that include non-former vested members in these groups that can serve on a board or that can elect their membership to the board. We believe interpreting members to include or to limit it to just active members is consistent with the legislative intent of these provisions. I went back to 2003 and I looked at the bill that restructured the board at that time, and it was enacted in that session. And while the bill itself only states members, it doesn't reference active or non-former, it just states members. The documentation you all get during session to help you deliberate these bills, the fiscal note, testimony on the bills, they all reference active member. And the post-session wrap-up, your 90-day report, when it spoke to this particular bill, it only talked about active members. When we presented a report at your request on trustee elections in 2015, throughout that report and in our presentation, we're only talking active members. So because of this, like I said, we believe this is the legislative intent of how we should interpret member in this situation. Because of this, we're recommending that legislation be introduced that would codify our existing practice and clarify that members to the board, serving on the board, have to be active members, and that the individuals voting, the members who would be voting, have to be active members.
And I want to, just because these tend to be technical, I'd like to take them one at a time and see if there are any questions. And yes, we do. Okay, Senator McCray.
Ms. Gotham, it's good to see you. Could you just clarify, like give examples of non-members? Could you say whether any non-members currently sit on the board or have been found participating in the voting process, or if any non-members have actually run for a position?
So what I mean by that, Senator, is when someone leaves, if they're not vested in the plan, if they don't have 10 years, or if they were in the plan before 2011, if they didn't have 5 years and they left, they're not vested, they leave, they're not eligible for any benefit. So, but the law says for 4 years after they leave, they are still considered to be in membership status. So if they were to ever return to state employment or with another participating employer, they would just resume within those 4 years. They would resume earning service again. Once they get outside those 4 years, then we consider their account to be abandoned, and we just try and track them down for purposes of returning their contributions. But that's what I mean when I'm talking about a non-vested former member still within their membership window. So these people, they're gone. They're not working for a participating employer. And I believe that's really not just with our plan, but with the other plans across the country. I think that's the intent. They want people on the board who are actually active members, who have skin in the game.
I guess the question too, it was like a 3-part question. Are any of the members that are currently on the board considered as the definition that you gave non-members?
No.
These non-members, are they voting in the process right now?
No. Only all of our members are active who are serving on the board. Anyone who voted in any of our elections, they are only active members.
Thank you for that clarification. Thank you, Madam Chair.
Thank you, Senator. This sounds like many of these board requested like a cleanup bill to make sure we're aligning everything across the board.
Yes.
Okay. Thank you, Anne. Okay. Seeing no others. Let's move on.
Okay. Next proposal has to do with the judges' retirement system and purchasing service. So currently, a member of the judges' retirement system can only purchase 2 types of service credit. The first would be service that's earned as a magistrate in chancery or a magistrate of juvenile causes that was earned prior to June 30th, 1975. The second type of service would have been earned as a member of the State Workers' Compensation Commission on or before June 30th, 1977. As you all know, mandatory retirement for judges currently is 70 years old. So using that as a marker, just for an example for this bill, that would mean someone who was retiring now, the oldest that we would have in the plan, would have had to have been 24 or younger when they were earning service as a magistrate in chancery or in juvenile causes, and would have had to have been 26 or younger to still be in the plan and have earned credit as someone on the Workers' Comp Commission. We went back and we looked, we have not received a request to purchase this type of service in over 20 years. So we believe it really is obsolete at this point. We're recommending repealing the provision. And in addition to that, to avoid confusion with our members in the judges system, we would also recommend including a provision that says purchasing service credit is prohibited in the judges' retirement system. I get a lot of calls from judges, very confused. Why can, where does it say I can't purchase service? I think this would help them.
All right, any questions on second recommendation? Okay. And maybe, and it's not a policy that you have, but it's also not a policy that you don't have. So you want to be clear that it is not a possibility to buy in.
Right. If you were to repeal this provision, if you were to accept our recommendation and repeal this provision, there would be no other language in the law that would allow them to purchase it. But we just want them to affirmatively see it.
Okay. Understood.
I
do see.
Yep. Delegate Proctor.
Yes, I just want you to expand on the rationale for saying this would be good for them. How do you view that?
When I say it would be good for them, I think it would. So I get a lot of calls, Delegate Proctor, with confusion from members in the judges system as to, hey, can we buy Service Week? Well, why can people in the employees pension? Where does it say we can't buy it? And I think it would, when I say it would be good for them, I meant it in a way, it would clarify for them. They would see an affirmative statement in the law saying it's prohibited that they can't purchase service in the judges' retirement system. That, I'll be honest, if you're not comfortable with that provision, what we're really concerned with is just getting the obsolete provision off our books. If you're not comfortable with adding an affirmative statement that they cannot purchase, we can live with that.
I think that, we need to consider it because there are, extenuating circumstances.
So, Delegate Proctor, I will bring this up. I did clear this with my counterpart with Judiciary. I told her that, told the individual that we would be introducing this legislation, and she was fine with it. So I do want you to know I did reach out to them. They are not going to be blindsided by this during session.
Okay. Thank you.
Seeing no other hands, Ann?
The next proposal is really technical in nature. We just found an incorrect reference to the state police death benefit in their drop plan. It's inconsistent with what the actual death benefit is, and so we're recommending correcting this. The actual death benefit is 80% at the retiree's death. The surviving spouse gets 80% of the benefit. In the drop plan, it references 50%.
We always appreciate every year your thoroughness in running through.
I cannot take credit for this. People come to me. I wish I was this detail oriented.
That is a true cleanup bill.
All right, the last proposal has to do with parole and probation reemployment. In 2012, when the parole and probation officers were still in the employees' pension system, legislation was introduced to provide for a reemployment exemption for them. So these individuals could come back after they retired, provided they were on a contract basis, and they would not be subject to the earnings limit in the employees' pension system. Now you fast forward to 2017, when you all moved the parole and probation officers from the employee system into the correctional officer system. The bill at that point did not include a similar reemployment provision exemption for the individuals who are now going to be in the correctional officer system. So as a result, we have this inconsistency. We can have people who have retired as parole and probation in the employees' pension system, and they're not subject to the earnings limit. And you have people who are going to retire as parole and probation in the correctional officer system, and they will be subject to the earnings limit. But because this issue really relates to plan design, I'm not coming to you with any specific recommendation for legislation. rather, I just wanted to alert you to this inconsistency and offer you some solutions if you wanted to do something about this. The first would be that you could obviously add a reemployment exemption for correctional officers. The second would be obviously to take away the reemployment exemption in the employees' pension system so no one would have it. I will tell you, well, we don't have a preference one way or the other. We just want consistency for our members in each, all serving as parole and probation. But I will also tell you, I've reached out to AFSCME on this bill because they were the ones who really were looking for the legislation in 2012. And again, they were the ones who really were pushing in 2017 to move everyone into the correctional officers. So I did tell them if they had a strong feeling about this legislation one way or another, if you're interested in sponsoring it, they should reach out to you and let you know.
Okay. That's good to know.
And that's what I've got this month.
That's what you've got. Okay. I see one question. Senator Elfreth, Chair Elfreth.
Senator McCray.
Just for clarification, so I can get a better understanding, was the pension system that you were talking about for the correctional officers, did that have anything to do with because we couldn't find correctional officers and them folks was coming back to work, or no, this has nothing to do with that?
That has nothing to do with this.
Okay, thank you.
Okay. Seeing no other hands, I do want to just Anne just mentioned no other bills this month, so we might get a few more prior to session, and we always appreciate your due diligence and your wonderful explanations of these very technical bills.
Yes, agreed.
Can I bank my 15 minutes that I didn't use for next month if I need it?
Deal.
I appreciate that.
Okay.
Great. Any final comments from anybody? Wonderful. Well, this was a great hearing. Really interesting information. We have a full day for our next hearing. I think the next one is the longest one of the ones we're having. So just be sure to block off a good bit of time. Thank you again. Thank you, Treasurer Kopp. I think we'll see you at one of the future hearings too. So this is not goodbye, but thank you for joining us today. And thank you to all of our guests for coming on today. For your explanations of the ecosystem here and what is possible. Really appreciated this and appreciate all of the members joining and for your attention today. Thank you. Chair Elfreth?
Yeah, I just want to, our next meeting is November 18th at 2 p.m. So a slight change in time, and that would be our longer meeting. So we're just asking to block off 3 hours. Hopefully we'll be able to give you some of that time back. That's one of the best gifts ever. And in the meantime, in the interim, if you are interested in working on any of the issues we heard about today or in our last meeting, please reach out to Chair Leemeren and myself. We'll be working with everybody here on trying to untangle this policy problem and see if we can't come up with some legislative solutions for next session. Treasurer Kopp, I believe you're going to be with us for the 18th. But she should be with us for the 18th, and I also want to thank her. And look,
I at 2 o'clock, did you say?
Yes. And we also look very much forward to what I'm sure will be a wonderful retirement celebration at some point.
Yes.
Thank you. May I just say, Madam Chairman, that hearing the discussion of our legislative proposals to you reminded me of one of the reasons I wanted to get off the joint pension.
Maybe it's not the reason that we all sweated out knocking on doors, but it still matters.
Oh, this kills me. This kills me to hear this.
We love you, Anne. Don't worry.
All right. Seeing no further discussion, Chair Lehman, I think we are adjourned for the day, and we'll see everybody on the 18th.
Thanks, everyone.